So before I move on to talking in more detail on the TAMIM Credit Fund, I might just take a few minutes for a discussion around what we believe is one of the more interesting and important features we see in private debt, and that's the ability to structure loans to include covenants which protect us as lenders or investors. And my apologies, I know we're showing our true colors as investment nerds, as we quite often get called by our relative spouses. To us, this is a really interesting area, and I thought probably a good one to include in today's presentation. So we've said it a number of times in the presentation and talked about the ability to structure private debt deals to provide strong levels of security on underlying collateral. And the protective covenants that we see are provisions that are included in loan agreements to help us safeguard ourselves by imposing obligations on the borrowers in this instance. As you can see on the slide, the four common types of covenants that we typically see being used by lenders in their loan documents: firstly, financial, then operational, affirmative, and finally restrictive covenants. A lot of these clauses or covenants are actually really just common sense, and you'll probably pick that up as we go through it now in the next few minutes. But when you leave them out of agreements, they will quite seriously or significantly weaken a lender's position. So within the financial covenants that we see in agreements, we typically will see clauses that refer to debt servicing abilities and debt service to coverage ratios. Will normally force borrowers to keep a certain amount of income or earnings in relation to the costs of debt or interest payments that the borrowers are making. This type of clause normally gives a lender confidence that the borrower will be able to continue to service their debt payments. Leverage ratios also fall into this category and serve to limit the amount of debt that a borrower can take on in relation to their equity or earnings. In the next area, which focuses on the operational side of a borrower's business, it's common to see agreements which would include provisions stopping borrowers from pledging assets such as collateral to other lenders. And that helps us ensure seniority in the lending capital stack. Quite often, you're going to see lenders preventing borrowers from selling significant assets without the consent of the lender, and that's the limitation on asset sales. In terms of the affirmative covenants, it's normal to see lenders requiring regular and detailed financial reporting from borrowers, and we're often in the position where we can enforce certain insurance requirements on borrowers, which is always nice, to make sure that they protect their ability to service loans and repay capital. And then finally, we'll sometimes see provisions whereby lenders will restrict the ability of businesses to pay dividends or distributions to the equity holders, and also potentially restrict the ability of the business to go out and seek further debt funding. So as you can see from the slide and the discussion on covenants, the private nature of these loan agreements allows us as lenders to better manage and mitigate the risks associated with lending to private companies, and the covenants provide a mechanism for ongoing oversight.